Today we are going to talk about merchandising operations. The first thing we need to understand is, what is a merchandiser? Well, a merchandiser is a business that sells things, goods or products to a customer. The things that are being sold, that's your inventory. We're going to look at a small business that has started up in the Flathead Valley called Thistles and Roses. The next thing that you need to understand is what is called the operating cycle of a business or merchandiser. The cycle starts out with cash. You take your cash, you go to the store, and you buy inventory or materials to make your inventory. And that's what we see here. Shopping for pieces to make some jewelry. Hopefully you have a really good product and everyone wants it and they buy it all up for cash, or sometimes they buy it on account, which isn't very common. This would be called accounts receivable. This would complete the operating cycle as we are back to cash, which we would take and buy more inventory. See how that works? So one more time. Cash is used to acquire goods or supplies from an individual or a business called a vendor. These goods or inventory are then sold to customers. The business collects cash from customers and the cycle is complete. Now, I would like to talk about two different ways that merchandisers keep track of their inventory. The first one is called the perpetual inventory system. This is a system that keeps inventory in real time. This means that as soon as something is sold, it is removed from your inventory. This type of system would require point-of-sale software that is connected to a scanner. Inventory is scanned in when it is purchased, and then it is scanned out when it is sold. A store like Home Depot has this type of system. As you can imagine, if they did not, it would take so many people so long to count everything in the store whenever they needed to know what they had on hand. It would be an overwhelming task that would be very expensive. There are a couple of benefits to a perpetual inventory system. Number one is that you always know how much inventory you have on hand. And secondly, is that it is easier and faster to calculate the cost of goods sold. You might be asking yourself, what is cost of goods sold? Well, that is a very good question. Cost of goods sold is defined as the cost of the merchandise inventory that the business has sold to customers. In other words, it is the amount of money you spent on inventory that you sold to someone. After you calculate that, then you can determine how much money you actually made, and that is called gross profit. Gross profit is calculated before you calculate net income and is completed by subtracting cost of goods sold from net sales revenue. After you calculate gross profit, you can subtract operating expenses and then you will have net income. The second type of inventory system is the periodic inventory system. A periodic inventory system is a form of inventory valuation where the inventory account is updated at the end of an accounting period rather than after each sale and purchase. A smaller business with less inventory would use this type of system. They only know how much inventory they have if or when they count it. Most small businesses still use a periodic inventory system, even though perpetual inventory management has become increasingly popular and more affordable as cost of software has come down and is increasingly more functional. The cost of a point-of-sale system would not be worth it for a small business, but it would be crucial for a larger one. A small business like Thistles and Roses definitely doesn't have a point-of-sale system, as everything is one of a kind and handmade. The operating cycle for Thistles and Roses is relatively short compared to a larger store that ships merchandise all over the world. The last thing I would like to talk about is the gross profit percentage. The gross profit percentage is a ratio that is used to evaluate a merchandiser's operations. This measures the profitability of each sale dollar above the cost of goods sold and is computed by dividing gross profit percentage, gross profit by